ADT is up big today, 12%, because Google and State Farm have agreed to invest in the company. So it's up big. So let's use our software and go check out ADT and determine if it's a buy right now. It's exciting to see 12% growth, right? So the stock is at $8 a share, up 12%, 52-week high of 10, 52-week low of 6. Let's go check out its 10-year chart. Now, it seems like it trades within, oh man, look at this. April 2020 hit 387, skyrocketed to 1348. Now it's at 8. All right, let's check this thing out. So a dividend here, 1.7%, higher than the market, pays out $121 million, and based on their free cash flow numbers, very manageable. Their free cash flow the last 5 years is almost $1 billion a year. Last year was 780. High gross margin, but this is the interesting part. Over the last 5 years, they've been losing money. They have no PE because they've been losing money. Let's go see more on the income statement about that. So revenue growth is not exciting and big, but man, they lose money quite a bit. Why is that? Are they special income charges? Some big special income charges, other income and expenses. Yeah, every year they have some big other income expense. Go understand those, because remember, just because there's other income and expenses, if they consistently do it, it stops becoming other income and expenses. At some point, you got to sit there and say, hey, is this just the MO of the company? So if you're new to this channel, I'm Paul. I'm a value investor. My goal is to find where price and value are disconnected, where price is lower than value. I look at it from a long-term perspective. I'm not worried about day-to-day or quarter-to-quarter or month-to-month results. I care about the long-term value of the business. And I use our 8-pillar process to tell a story about the company and then make assumptions about the future and find opportunities where there's a disconnect. That usually means finding companies where there's a bad news story about it, because people just tend to overreact. Just like when there's a good news story, people will overreact on the high side. I want to find situations the opposite. In this situation, you have a great story. Google and State Farm have invested in ADT. That's a big jump. Disclosure, I personally have ADT in my home. I like it a lot. It's a great service. I think our CEO, Tim, his wife used to work for ADT. Love the service as well. So I have looked at ADT in the past, but I don't really remember it. So let's go look at the 8 pillars tab here. Okay, so our 8 pillars tab. Again, they have no PE because they haven't made money, but they have free cash flow. So that's interesting. I really want to understand why there's free cash flow, but no PE. Shares outstanding, they've increased by 22%. This is diluting people as owners. That means if you own a share 5 years ago, you now get 20% less revenue, profit, and cash flow than you did 5 years ago. A lot of debt, but, well, it's a lot of debt, guys. That is a lot of debt. Revenue up 1.4 billion, net income down 375, free cash flow down 340. So my first question is, are they spending a lot of money growing internally? But then I look at the income statement and I don't see a lot of growth here. It's very little growth. I mean, look at the revenue year over year. 4.4, 4.8, 5.3, 5.2, 5.8. It's not some major revenue growth. So that's kind of a concern of mine. Let's go see what the analysts are saying. So new to our software, we have analyst estimates, both quarterly and annual. This year, now here's the interesting part. They're expecting almost doubling of their profit. But keep in mind, there aren't many analysts watching this company according to our data feed. I'm sure there are way more than this out there, but our data feed's providing these numbers. Revenue growth. Wow, big revenue growth numbers. I'm actually surprised by this. 6.4 to 8.75. Again, not many analysts. All right, so I'm wondering why EPS is showing here, but they haven't made money, but they're all of a sudden expecting them to make money. All right, so what do we do with all this? Well, guys, we have the Stock Analyzer tool. And if you're new to our channel, we created this tool specifically for our users because it's a model to be built on the future. Every investment is the present value of all future cash flow. And your goal is to make assumptions about the future because we have no idea what's going to happen in the future, but we can use the past and some projections to see what's going to happen and determine if we can pay a reasonable price for the company. Now, in this situation with ADT, the issue we have is we have no profit margin in the last 5 years, right? So it's going to be hard to determine that. Now, they're expecting 60 cents per share in profit, and they have 850 million shares. So that's what? $500 million in profit, roughly. So that's something we can, on revenue of 5.8 billion, so that's 9%. right? So I can fact that in here, but again, I also want to look at that free cash flow number and determine that. So this company's getting a little harder, and I'm going to show you in our desired annual return how I'm going to put a higher margin of safety. Please watch this video, especially the stock analyzer part, over and over if you want to understand it better. So first things first, I'm doing a 10-year analysis, and I can do anywhere between 1 and 20. Revenue growth. I'm going to go with 3, 6, 3, 5, and 7, based on the analyst estimations in the future. Profit margin. I'm going to do 5, 8, and 11. Free cash flow, I'm going to do 9, 12, and 15. Because look, they did 13.5 last year, 18% over the last 5 years. But free cash flow and profit margin should be the same over long periods of time, or very similar. All right, this is a tough one. So PE. I'm going to go a little bit higher on PE because it seems like their earnings don't match their free cash flow. And I actually like the fact that their free cash flow is higher than their earnings. It's more concerning to me when it's the other way around. And the reason being is earnings are easier to manipulate because of all the rules at the SEC with taxes and all that stuff and accounting rules. So keep that in mind. So for PE, I'm going to go, it's a great brand, but doesn't have much growth. I'm going to go 13, 16, and 19. Price of free cash flow, I'm actually going to go 11, 13, and 15. And desired return, I'm going to go 12.5, 15, and 17%. The reason 17.5%. And here's the reason. To go into the stock market and buy a low-cost ETF, you'll get 9 or 10%. So give yourself some sort of margin of safety and a reason to buy an individual company. But the bigger your assumptions are, the higher your return should be because it'll push the price down, right? The more you pay for something, the worse your return is. The less you pay for something, the higher your return is. So for here, if I'm making low assumptions, I'm okay going with a lower return. High assumptions, I want a higher return because I'm more likely to be wrong. Now, I'm going to hit the analyze button here. 6 numbers are going to pop up. 3 numbers based on low, middle, and high based on earnings, and low, middle, and high based on free cash flow. If it's all green, that doesn't necessarily mean go buy. What it means is go do more research. Go figure out if these numbers are correct. How do you do that? Scuttlebutt. Go on the internet. See what other reputable people are saying about the company. Go to analyst expectations. Go read their reports. But most importantly, go to our EM community. Join that community. It's less than a cup of coffee per day. There are thousands of investors in here. And I assure you, based on today's action of 12%, people in there are talking about it. And they're going to do research on it. It's much easier to do research as a group than it is individually. So join that community. The reason we created it was being a value investor is a lonely road at times. But now, because of the internet and YouTube, we can all come together as a group and talk about investments together. So I'm going to hit the analyze button. I hit it, $8 per share. All right. Low of 3 to 6, high of 9 to 10. And it's right now, right in that ballpark. I think this justifies doing more research on the company. So if you like this video and you want to understand more about our 8-pillar process, click our next video on our 8 pillars. And don't forget to subscribe to our channel. Thank you very much for your time.